Hello. Hello, can you hear me? Hello.
Yes, we can hear you, Grace.
Oh, thank you. I was trying to do some connections. Thank you so much. Welcome to today's lesson. Today we are going to look at what you are calling intrinsic value and how it applies in business. So today we are looking at intrinsic value. So we are going to use questions so that you can be able to understand what intrinsic value entails. Basically, in today's lesson, we are going to talk about shares. And in Kenya, we have companies that are listed in Nairobi Stock Exchange. So we have companies that are listed in Nairobi Stock Exchange. If you can Google, you can be able to see a number of companies. So we have companies like Safaricom, we have Equity Bank, we have ABSA. Actually, many organizations or companies in Kenya are listed in Nairobi Stock Exchange. So, if Safaricom wants money for investment, what do, they sell shares. They sell shares to common mwananchi. So, a common mwananchi will have shares, but they will pay for those shares. So, for example, right now, what is the price for Safaricom shares? The current market price. Anyone with an idea? Or you can just Google the current market price. can tell us the current market price for Safaricom shares? Or do you have people who trade in terms of buying shares and selling shares? So in a financial management class, it is important that you know these things. Anyone? Okay, there's no one. Yes? Okay, at what price? 18.20. Thank you. Okay, thank you. So Safaricom shares current market price, let's use 18 shillings. So for every share you buy, for you to have one share will cost you 18 shillings. So why do people buy shares in these companies? It is a form of investment. So some people buy shares because of what we are calling capital gain. Capital gains. And number two reason for buying shares is dividend. Capital gains, and then we have dividends. Those are the two reasons why people buy shares. So I just want to explain it very slowly so that you can get the concept. So that when we go to the mathematics aspect of it, at least you'll have an idea of what is happening. When I tell you the dividend grew, or in the first year the dividend was 3 shillings, and then in the second year the dividend grew at the rate of 10%, you will not be stranded on what that means. So people buy shares because of capital gains. Number two, dividends. So what is capital gains? Today Safaricom shares is 18 shillings per share. With Safaricom, actually I think since elections the shares have dropped in terms of price. The shares have really dropped because I think 2022 at the beginning the shares were around 30 shillings. So they dropped up to 13 shillings. Then now it seems that the share price is increasing. So if it is increasing, right now it's 18 shillings, the probability of Safaricom shares increasing up to 38 shillings is 100%. So 18 shillings to 38 shillings. So what people do, when the shares are at a low price, they buy the shares, and then when the shares increase in price, they sell the shares. So for example, if the share right now is 18 shillings and you buy shares maybe worth 50,000 or 100,000, then you wait, you be patient up to when the shares will be 38 shillings or 30 shillings. The issue is patience. because sometimes they can even drop. So but right now you can see the shares are increasing in price. So that means that the shares in the next few months, or maybe by next year, the shares will be at 38 shillings or at 30 shillings. So if you had bought shares worth 50,000, divide by 18, then it means that you can be able to sell the shares at a higher price. That is what we are calling capital gain. Buying shares at a cheaper price and selling the shares at a higher price. So another reason why people buy shares is because of dividends. Each and every company gives dividends, but the dividends vary. Some companies give dividends. There is a company called BAT, British what? American Tobacco. I think their shares, the dividends is at 20 shillings, of course, and their market price is very high. So some people normally invest in those companies for the sake of dividends. So that means that and dividends are considered to be a what income? I'm forgetting the name, but it's a form of income. Passive income, yeah. Dividends is considered to be a passive income. It means that as long as you're a member of a company or that company, you will be receiving dividends. Most SACCOs, if you're in a SACCO, I know you receive dividends at the end of a certain period. So dividends is called profit, and this profit is normally shared to the members of the company or the shareholders of the company. So dividend is a form of profit, and dividends is normally given to the shareholders. I think now when you understand the meaning of dividend and when you understand capital gains, now we can be able to look at a question and we can be able to get better understanding. Chigiri Limited is a private company which intends to be listed in the Securities Exchange. So this is a private company and it intends to be listed in the Securities Exchange. So in Kenya we call it Nairobi Stock Exchange. In other countries, we have names of those securities exchange. So the company has recently made a dividend issue of 3 shillings and 20 cents. So that means that when you buy shares in Chigiri Limited, you will receive a dividend of 3 shillings and 20 cents. The dividend is expected to grow at the rate of 15% per annum for 2 years. So that means that the first 2 years, so for example, we are in 2024. So if we buy shares in this company, we are expecting a dividend of 3.20 shillings. And then the dividend will grow after 2 years. So that means that the first year and the second year, we are going to receive 3 shillings and 20 cents. But now, it will grow at the rate of 15% per annum for 2 years. And then 12% per annum for the next 3 years. So for 2 years, that means that, is it this year and next year? Year 1 and 2, the rate will increase. Then we have for the next 3 years. After the 2 years, the next 3 years, dividends will grow at the rate of 12% per annum. Thereafter, the dividend will grow at the rate of 6% per annum indefinitely. So, here we are saying the first 2 years the dividend will grow at the rate of 15%. So 15% 2 years. Then after 2 years, the next 3 years. So if we are looking at year 1 and year 2, we have a growth rate of 15%. And then the year 3, 4 and 5, the next 3 years, the growth rate will be 12%. Thereafter, the dividend will grow at the rate of 6% per annum indefinitely. So after 5 years, the dividend is going to grow at the rate of 6% per annum indefinitely. Indefinitely means until further notice, or as long as that company exists, or until the company policies change. So the dividend will grow at the rate of 6% per annum indefinitely until further notice. So that means that after 5 years, now the dividend will start growing at the rate of 6% per annum indefinitely. Then you have the required rate of return is 11% per annum. We look at this term when you're looking at a topic called portfolio. So every time you make an investment, there is what we call the required rate of return. What is the rate of return of that investment? So in this case, when you invest in shares in this company, the required rate of return, or the rate that we are going to have our returns, we are considering it as 11% per year. Then you're required to calculate the intrinsic value of the share. You're required to calculate the intrinsic value of the share. The good thing is that when this question comes, it is never twisted. So let's just proceed. So there are two methods of doing this question. I'll show you the two methods, but I will insist, or I'll advise on using one method. But you'll have a choice of using the method that you want, but I'll insist on using, but you'll see the difference between the two methods. So method 1 is this one. It's very easy. What you do, you're going to create a column that is called year. We're going to start with the years. So according to this question, we have the dividend is expected to grow at the rate of 2 years. So we have year 1 and year 2. And those 2 years, the dividend is expected to grow at the rate of 15% per annum. So year 1 and year 2, we will have an interest rate of 15%. So what we basically do in the first 2 years, we have 3.20 as our dividend. So we want to see at the end of the first year what will be our new dividend. So we will have 3.20 into bracket 1 plus 15% is to power 1. Why are we saying power 1? Because this is the first year. That is why we are using power 1. So that means that when you solve using your calculator, of course I advise that you start from here. 15 divided by 100 is 0.15. 1 plus answer, then whatever you get times 3.20. You are supposed to get a new dividend of 3.68. So the dividend is going to grow at the rate of 15%. So you're supposed to have these. So I'll explain and I'll be able to give you a question before the lesson ends so that you can try it out. Then we proceed. In the second year, the rate is still 15%. The only difference is that here we are going to say 3.20 into bracket 1 plus 15% is to power 2. Power 2 because it is the second year. And here we are using the rate of 15%. First year, second year, same rate. But remember here we are saying power 2. So you're supposed to get 4.232. I'll be able to explain the PVIF part. So then you proceed. So the first 2 years, the dividend is 15%. And then 12% per annum for the next 3 years. So that means that after the second year, we will have, now we are going to use this dividend 4.232 here, 4.232, 1 plus 12%. 12% is our new rate for the next 3 years. So here we are going to say 4.232, 1 plus 12% power 1. We get 4.74. So in these other years, you are going to use 4.232, 1 plus 12% is to power 2. Then 4.232, 1 plus 12% is to power 3. So note the difference. The first year and the second year, we are using power 1, power 2. Third year, because we are using a new dividends per share, so we are not using 3.20. There is a new dividends per share. That is why we are using 4.32. And because you have been told that the interest rate will be 12% for the 3 years, that is why we are using 4.232 year 3, year 4 and year 5. And here we are using power 1 because here we are considering these as the first year with 12%, the second year with 12%, and the third year with 12%. So first 2 years, power 1, power 2. The interest rate 15%, 15%. Third year, power 1, power 2, power 3. Interest rate is 12%, 12% and 12%. And that is where you're going to get these values. From here to here, is there any question or clarification? So it means that you have understood. That is very good. So let's go to now PVIF. The formula, yes, Lorraine, you have a question?
Yes, I have a question. I'm slightly lost. You see in year 3,
Yes. Year 3, 4 and 5. Yes, if you are given a different rate. Yes. If you are told that, for example here, the dividend is expected to grow at the rate of 15% for 2 years, then 12% per annum for the next maybe 5 years. we could still use the same 12% for year 6 and 7, power 4, power 5. Okay. Welcome. I hope that is clear. Now let's proceed to PVIF. So who can tell us the formula for PVIF? PVIF means present value interest factor. So let's try this one. 1 plus rate, 1 plus R. R is the rate, and for PVIF we use the required rate of return. This one, 11%. So we are going to say 1 plus R is to power negative n. 1 plus R is to power negative n. R is the 11% and power negative n. N is what? The year. So if you use that, what are you getting? So we are saying 1 plus 11% is to power negative 1. The PVIF, we use the required rate of return, this one, not the growth rate. Tunatumia required rate of return, which is always given. So let's see. Yes, exactly. So what are you getting as the answer? So just use your calculator. 1 plus R, and our R is 11%, power negative n. .9009. I hope all of you are getting this figure. That one is correct, very correct. So that is for the first year, we use power negative 1, which is just there in the calculator. The second year, 1 plus 11%, power negative 2. See if you're getting this. One plus 11%. Power negative 2, 0.8116 minutes, correct? Yes, Mulobi, you have a question? Oh, yeah. And I hope I've answered. 1 plus 11% is to power negative 1 for the first year. 1 plus 11% is to power negative 2. The formula is 1 plus r into bracket negative n. 1 plus, the next one is 1 plus 11% is to power negative 3. 1 plus 11% is to power negative 4. And the last one is 1 plus 11% is to power negative 5. So for PVF is easy because we are just using power negative 1, power negative 2, power negative 3, 4, and then 5. You're supposed to get the PVIF for the first year, the first 5 years. Any question about PVIF up to here? Because I'm going to explain something about the last year. Lorraine, you have a question? Or any question? Is there? So from Mulabi, have a question? Yes. One plus 11% is to power negative n. N is the number of year or the year, so is to power negative 1. Then 1 plus 11% is to power negative 2. 1 plus 11% is to power negative 3. We are supposed to get these figures. From there you can use the present value. Present value is 3.68 times PV. This one is PV. So we start with PVIF, then PV. 3.68 times 0.9009. Confirm if you are getting this. I wish you can be a bit faster if you have your calculator. The next one is this one, 4.232 times 0.8116. Maybe someone can confirm the first one first. Yes, I can see in the in call you got the answers right. 3.315. Yes, correct. Okay. So that is what you do for you to get the present value. PV. Multiply this times this times this. So I want us to go to this last part. I want us to go to this last part. So we have calculated the dividend and the present value for the first 2 years and the next 3 years. But we have not calculated the present value. Thereafter, the dividend will grow at the rate of 6% per annum indefinitely. So when you're told about indefinitely, what you do, you first come here and calculate what is called the value of share in year 5. The value of share, or you can just say the value of share. The formula is D into bracket 1 plus G over R minus G. D stands for dividend, which is the dividend for the previous year. So we want to calculate the present value for indefinitely using the rate of 6%. The growth rate is 6%. So we use the same dividends of 5.95 into bracket 1 plus G. The growth rate is 6% indefinitely. So 1 plus 6% over R. R is the rate. The rate here is 11%, which is the required rate of return. The required rate of return is 11% per annum. So we have 11% minus G. G is the growth rate, 6%. So these things are just in the question. So dividend will grow at the rate of 6% per annum indefinitely. Grow at the rate. So this is the growth rate. The required rate of return is 11%. This is our R, the rate. So 5.95 into bracket 1 plus 6% over 11% minus 6%, you're supposed to get 126.14, which in this case will be the value of the share. And for indefinitely, we use the same PVIF. So hapa we don't get another PVIF. You can see here we have 0.5935. We still use the same 0.5935. Then we multiply 126.14 times 0.5935. You get 74.864. Then you add for you to get the intrinsic value of the share as 92.107. So here you just use this formula and you put in the values. Any question about how to calculate the intrinsic value of the share? Yes? You didn't get where? 92. Or add 3.315 plus 3.433. Add everything mpaka hapa. Yeah. Welcome. Yes, Mulobi, have another question? This one is the growth rate. Okay. If we are good in this, I want to show you a different method that is a bit simpler. And then there is another question that you can check out that is already done. So Bemunyonga Limited has just paid a dividend of 4 shillings per share. So here we are paying a dividend of 4 shillings per share. The company expects that the dividend will grow at the rate of 20% per annum. For the first 2 years, we are expecting the dividend to grow for the first 2 years at the rate of 20% per annum. So first 2 years, 20%. Then after the first 2 years, then grow at the rate of 10% for the next 2 years. First 2 years, 20%, then 10%, the next 2 years. And thereafter, grow at the rate of 6% per annum into perpetuity. Into perpetuity, it means that it will grow now at the rate of 6% indefinitely until further notice. So then we have the required rate of return as 16%. You are required to calculate the theoretical value of the company's share. So sometimes you can be told intrinsic value, sometimes you're told the theoretical value of the company's share. So what you do is what we have already done. The only difference is that here we will make it to be much simpler. So of course, how many years do we have? The company expects that the dividend will grow at the rate of 20% per annum for the first 2 years. So we have year 1 and year 2. And then grow at the rate of 10% per annum for the next 2 years. So 10% year 3 and year 4. And then indefinitely. So we have 4 years and then now we have the indefinite year. So the method that I was telling you, and I would like to insist that you use it, is this one. So we have a dividend of 4 shillings per share. This one, the dividend that has just been paid. So when you see the initials, DPS means dividend per share. So we have 4 into bracket 1 plus 20%. 4 into bracket 1 plus 20%. And then now the growth rate for the first 2 years is 20%. So here we are going to use 4.80. Of course, here we will have 4.80. Then this 4.80, we proceed with it in the next second year. 4.80, the same 4.80. 1 plus 20%. 4.80, 1 plus 20%. So the first 2 years we are using the rate of 20% and 20%. We get 5.76. This 5.76, we use it in the third year. So there is no like spacing, 2 years, 3 years. No. They follow each other. 4.80, 4.80. 1 plus 20%, 5.76. 5.76, 1 plus 10%. So the first 2 years, we are using the rate of 20%. The next 2 years, we are using the rate of 10%. So it will be 5.76, 1 plus 10%, which will give us 6.336. 6.336, 1 plus 10% again, which will give us 6.9696. So this one is a bit easier because you don't have to think first year, second year, no. Everything is power 1, or you just don't put the powers. but the answer that you get is what you start with in the following year. Whatever you get, unaanza nayo. Whatever you get again, you start with it. And now you have 6.99696. From there, for us to be able to get this figure, now we use the same method for value or price of share, which in this case, we're going to use D0. D0 is our dividend, this dividend, the previous one. So here we are want to calculate the dividends for indefinite. So 6.9696, 1 plus G. G is the growth rate for indefinite. So the growth rate thereafter grow at the rate of 6% per annum into perpetuity. So 1 plus 6%. Then 16% is the rate. The required rate of return is 16%. So 16% minus 6%. So that means that the dividends that we will have now will be 73.88. Up to here, is there any question or clarification? Okay. If there is no question, we proceed. For PVIF, we have said the formula is 1 plus R is to power negative N. So here for the first year, for year 1, 1 plus R. R is 16%. So 1 plus 16% is to power negative 1. The required rate of, so for PVIF we use required rate of return. 1 plus 16% is to power negative 1. 1 plus 16% is to power negative 2. 1 plus 16% is to power negative 3. 1 plus 16% is to power negative 4. And then the same PVIF is what you're going to use for the indefinite. So here we'll have 0.5523. You multiply, so you start by 5.80 times this, supposed to get the present value. 5.76 times 0.7432, you multiply, then you add for you to be able to get the theoretical value of the company's share, 57.13. Is there any question? So if this is clear, this one has I wanted us to do this, but I can see time is not on our side, so we can just go through it. An investor holds 1,000 ordinary shares in Upendo Limited, a company quoted at the Securities Exchange. The company has been paying average dividends of 1.50 shillings per share annually in recent years. So the dividend that has been paid is 1.50. The firm's dividends are expected to grow at the rate of 10% per annum in the coming 3 years. So 10% is for 3 years, then grow at the rate of 8% per annum over the next 2 years. So 3 years 10%, 2 years 8%, and thereafter grow at a constant rate of 5% per annum into perpetuity. So we have 3 years, then we have 2 years, Then you have perpetuity. The required rate of return is 12%. Using the discounted cash flow method, valuation method, determine the current value of the 1,000 ordinary shares of Upendo Limited. So there is no other method, it is still the same method. So we have the first 3 years you are supposed to use 10%. Is it 10? Firm's dividends are expected to grow at the rate of 10%, then grow at the rate of 8%. So there is a mistake here, kindly correct it. Here it's 8%, but I'm sure you'll get the same answer. So 8% and 8% here. Kindly ensure that you correct these. So the first 3 years you're going to use the rate of 10%. So we say 1.50, 1 plus 10%, 1.65. We use it in the second year, 1.65, 1 plus 10%, 1.815, 1.85, 1 plus 10%, 1.9965, 1.9965, 1 plus 8%, 2.15622, 2.15622, 1 plus 8%, you're supposed to get 2.3287. PVIF still remains. We use the required rate of return of 12%. So 1 plus 12% is to power negative 1, 2, 3, 4, up to 5. You're supposed to get that. For the price, we still do the same. D0, 1 plus G. D0 is this one, 2.3287, 1 plus G over KE. This one is the rate of 12% minus G, 34.93. Use the same PVIF. You're supposed to get 19.82. Then you add for you to get the present value. But here we have been told to determine the current value of 1,000 ordinary shares. So you are going to say 1,000 times whatever you get here. So for you to get 26,853 shillings. And that is how you're supposed to do that. So is there any question on that? So I'll be able to share this document in our WhatsApp group, and also the video lecture will be uploaded before. It normally takes some time, but I know before I sleep you'll have the video lecture. So kindly ensure that you go through all the video lectures, because there is no lesson that has not been uploaded on our Telegram group. So in case you missed any lesson, kindly go through it at your own time. So so we are going to meet tomorrow for economics. Then I think the other week, that is when you can schedule for extra lessons, so that at least by the end of July or even at the middle of July we'll be done with the whole syllabus. If we can be able to sacrifice, especially for financial management, if we can have a week or two, we can be able to clear the syllabus for financial management, so that you can have enough time for revision. So kindly ensure that you go through these lessons, so that, because we will add more concepts as we proceed the classes. So if there is no any other issue, kindly let's meet tomorrow for economics. Thank you so much for your time. Have a good evening. Thank you.